Our next business form is the limited liability company, or more simply known as the LLC. The LLC is designed to be a hybrid between the corporation and a partnership. Really, what an LLC, in a little bit more detailed explanation, is really supposed to improve on the limited partnership. As you recall, the limited partnership has some limited partners and some general partners. The limited partners have limited liability, the general partners have unlimited liability, and that was designed to take advantage of the limited liability feature of the general corporation and the simplicity feature, or the taxation benefits, of the partnership. And so at some point, somebody woke up in one state, I don't know which state started it, probably Delaware, one of those, and woke up and said, I have an idea. Why don't we do something that is similar to a limited partnership, except nobody has unlimited liability. Everybody has limited liability. In other words, we'll make the whole thing just like a corporation when it comes to liability, but just like a partnership when it comes to taxation and the other aspects. And so they formed and the LLC was born. So the LLC, in terms of its formation, very similar to a limited partnership, but it has that one big advantage that nobody has to be a general partner. There's a managing member of an LLC, but the managing member's liability is limited as well. In other words, even the managing members are not personally liable for debts of the LLC. So forming an LLC is very similar to forming a limited partnership. You file articles of incorporation or articles of organization, and the shareholders are called members, and then there are managing members who are the people that actually run the company. You've got limited liability for all members, you've got no double taxation, you've got easy transferability of shares. In other words, you can transfer interest. Just like a corporation, you can sell parts of an LLC, you can give shares of an LLC, you can transfer shares of an LLC. In that way, it's a lot better than a partnership. Remember, in a partnership, when a general partner or any partner in a general partnership leaves, then the whole thing automatically becomes dissolved. That is not true with an LLC. With an LLC, you can transfer shares, you can transfer ownership interests, you can transfer interests in the LLC, and the thing does not get dissolved. So therefore, you've got good capitalization potential, no cap on the number of members. We'll see in the S corporation is a different type of corporation, has a limited number of members. LLC has no limit on the number of members. You can sell shares, you can buy shares, you can get investors. And in terms of the control of the LLC, the members don't inherently get rights to vote. That was one of the problems with the partnership, that everybody has an equal stake in the management. Well, that's not necessarily true with an LLC. With an LLC, you can have a managing member, and the managing member is the person that actually runs the show. See, the LLC, as you can see, is really a very good business form. It's better than, it has a lot of features that are a lot better than all the others that we've discussed so far. And in fact, it's probably the single most common business form of new businesses when they start, assuming they're not a sole proprietorship. In other words, if you're going to go actually and form one and go to the state and pay the fee and file, you're probably going to end up forming an LLC. There are still limited partnerships around, there are still corporations around, but the LLC, generally speaking, is a very strong form of business and a very popular form of business. And another great thing about the LLC, interestingly enough, is that as you can see over here, an LLC can elect to be taxed as a partnership, but it doesn't even necessarily have to do that. The IRS, and from far as the tax code goes, there's really no such thing as an LLC, because an LLC is something that is created by state law. The IRS doesn't even really recognize an LLC, because an LLC can choose to be taxed as a corporation or to be taxed as a partnership. So as an LLC, you can actually choose from year to year based on which is a better idea for your particular company at that particular time. Usually, LLCs will choose to be taxed as a partnership, but if for whatever reason they want to be treated as a corporation for tax purposes, they can choose to do that as well. The owners can manage the business, and of course, all owners, even the managing members, have limited liability. These are created by state law. I mean, really, all of the business forms we've discussed are a matter of state law. if you want to form a corporation or you want to form a limited partnership, you have to file something with your Secretary of State, not with the federal government. But as I mentioned before, the corporation has special rules with regard to federal taxation, for example. They have to file their own Form 1120, which is a corporate tax return. A partnership has to file a Form 1065. An LLC can kind of choose because the federal law doesn't even really make a provision for an LLC, although it does specifically allow LLCs to choose whether they want to be taxed as a corporation or to be taxed as a partnership. And just like you have the Uniform Partnership Act and the Uniform Limited Partnership Act that usually defines how partnerships are run and what their default rules are, you've got limited liability company codes. The Limited Liability Company Act and the revised Uniform Limited Liability Company Act, etc., that determine how LLCs are run. The LLC is a separate legal entity. In that way, it's a lot like a corporation. An LLC can own property, an LLC can sue and be sued, can enter into contracts, and can even be found guilty or civilly liable, and can be punished, can be fined, can even be shut down by the government. In this way, an LLC is very much like a corporation. A corporation has a status of a separate legal person, and the LLC also has a status of a separate legal person. And the LLC, assuming the articles of organization don't specify otherwise, is governed by the uniform rules that are covered by the Uniform Limited Liability Company Act, or the ULLCA, which of course is the LLC's version of the Uniform Partnership Acts, or the Uniform Limited Partnership Acts that we discussed a little bit earlier. Now, all of these rules are only applicable if they are adopted by the states. Basically, what a uniform rule is, I didn't mention this earlier, but really what a uniform rule is, it's a series of rules that are written by experts in the field, not by any particular government employee, but by experts in the field, and then the states, if they want to, can adopt these rules as their own state's rules. Now, some of these have been adopted, some of these uniform rules have been adopted by every state, like the Uniform Commercial Code. Then there are some that have been adopted by some states and not others, like the Uniform Probate Code. There are some uniform rules that haven't been adopted by any states, like the Model Penal Code. But I'm not going to worry about that too much right now. That's not really the key thing. The key thing is that the ULLC, if there are rules that govern a particular case, they're not necessarily binding on a particular state or on a particular LLC unless that particular state has adopted the ULLC as its own state's rules. And again, just like a corporation, an LLC has powers to do things like an independent legal person. It can own, mortgage, or transfer property. It can do the same for personal property, real property and personal property. It can enter into contracts. It can make guarantees. It can borrow money. It can issue notes, issue bonds like corporations can. It can borrow money and borrow money from shareholders. And of course, can sue and be sued. It is an independent legal person just like a corporation. And the members have limited liability. The limited liability applies to members of the LLC, and that means that members of the LLC are only liable to the extent of their capital contributions, which means you can lose what you invested, but you cannot lose more than that. Of course, one little caveat to that, and this is always true, whether you're talking about a corporation or an LLC or a limited partnership, if the person actually commits the tort. In other words, if I own the LLC, and I'm running a restaurant and I negligently, give somebody food poisoning, well, I can be sued personally, even though it's an LLC. That doesn't protect me if I personally committed a tort. If I personally damaged somebody, I can still be liable. But the point is that a debt strictly of the company does not transfer as my own personal debt. And this is a chart that kind of illustrates this concept of liability. And that is, you have the members who invest in the LLC, and the LLC can owe money to the third party. So the third party can collect money from the limited liability company, can sue the LLC and collect whatever money is in there, but cannot directly get money from the members. So that's why the investment is limited to a capital contribution and there's no personal liability. I think we've covered this concept in many different ways so far in this course. And just like any other business, the LLC is liable for loss or injury caused by an action of a member, manager, employee, or agent in the ordinary course of business. This is really a tort rule, and the rule is something called respondeat superior, which means the boss, literally, it means the boss has to respond or the boss has to answer. So if you have a business and somebody who is representing the business, somebody who works for the business, signs a contract with a vendor, or commits a tort in the ordinary course of business, then the company is going to be liable, just like any other business. Okay, as far as the LLC goes in terms of how it's formed initially, well, we've got the formation of an LLC, and the formation of an LLC is simply, well, is similar to the formation of a limited partnership. An LLC can be organized to operate businesses, real estate developments, etc. Certain professional groups may have to form their own special type of LLC. Some states have a PLLC, which is a professional LLC. Things like law firms and doctors' offices, dentists' offices, other professional offices may have their own special type of company that they have to organize, but virtually all businesses can establish and run as an LLC. An LLC can be organized in only one state, even though it can conduct business in all other states. You can go form a Delaware LLC, and it may go and then do business in multiple states that are separate. Again, that's true with corporations in general. The way the LLC forms is by establishing or by filing, by drawing up and filing in articles of organization. The LLC is formed by delivering the articles of organization, which is a series of initial rules that set up the LLC, to the Secretary of State for filing, and that has to include certain very basic information. This is very similar to the Articles of Incorporation for a corporation. It has to include basic things like the name, the address of the office, name and address of the agents and organizers, the type of LLC being formed. It also specifies what it's organized for, but it can be very vague. For example, it can specify that it's being established in order to do any lawful business or to make money or something like that. So it can be very vague, and very often it is very vague. A duration in LLC could be perpetual, or it could be limited to a specific period of time. Most LLCs that are formed are simply perpetual, which means they exist until they're dissolved. A capital contribution to an LLC is very similar to a capital contribution to a partnership. Anything can be contributed to an LLC, which again includes services, includes promissory notes, other agreements, money, tangible, intangible, and not excused by death or disability, which means that just like when you're talking about a partnership, this becomes something that is owed to the partners, or to the LLC members. If the LLC member dies, well then, as we'll see a little bit later on, there's no right of survivorship necessarily when you're talking about an LLC, because when an LLC member dies, his or her shares are like shares of a corporation. It goes to the person's family. It goes under the person's will. Just like if a person dies and owns stock in Google, that Google wouldn't go to the other shareholders of Google. That stock in Google would go to the person's heirs. Well, the same thing is true when you're talking about an LLC. You may have noticed so far there's a kind of a theme going on here, and that is an LLC is very similar to a corporation. The only major difference between a corporation and an LLC being the issue of taxation. Whereas a corporation pays its own income tax, the LLC taxation is, if it elects to be treated as a partnership, is taxed directly to the partners. An LLC gives out certificate of interests, which are certificates that illustrate how much stock or how much ownership interest each person has, similar to a stock certificate when you're talking about a corporation. Today's day and age, you might not have paper certificates. They could be done electronically, or they could be just done in the books. But in other words, you have the same structure. Just like instead of stock, they call it interest. Instead of stockholder or shareholder, you're called a member. But it's the same basic idea. And an LLC can have an operating agreement. An operating agreement is an agreement among the members that governs the affairs and business of the LLC and the relationship among the members and managers of the LLC. And it can be amended, which means to be changed by the members. either by a majority vote or by unanimous vote, again depending on what the original document said. Just like corporations have bylaws, an LLC can have an operating agreement, which specifies virtually everything about how the business is going to be run, and how this document itself can be amended later on, if at all. According to the Uniform Limited Liability Company Act, each member has the right to an equal share of profits and losses. That's the default rule when we were talking about partnerships, and that's the default rule when we're talking about LLCs. Of course, if there is an operating agreement, the operating agreement can specify something else. Then you have the distributional interest. The distributional interest requires the members to receive distributions of money and property from the LLC. This is like having stock. This is like having the ability to get profits from the LLC. By having a distributional interest, you have the right to be distributed, along with the other members, your share of the profits. Now, an LLC can be member managed, or it can be manager managed. It can be member managed, which means in a member managed LLC, all members of the LLC can bind the company by agreeing to contracts with outside vendors or outside parties. And in such a case, each member would have equal rights to membership, regardless of their capital contribution, and any matter would be set to a majority vote. That's one possibility. And again, how is this determined? This is determined by the operating agreement. Otherwise, the operating agreement can specify that a manager is only a manager or only a group of managers are entitled to bind the LLC, are entitled to do business on behalf of the LLC. Those people would be called the managing members. Almost always those are people that are actually members, and they're chosen from among the members to manage the LLC. So the members and non-members who are designated managers control the management. They don't have to be members. For example, if you want to hire an outside manager, like a chairman of the board when you're talking about a corporation, that person doesn't have to be a member. Usually the manager is a member, but if you want to hire a financial professional to run the LLC who's not a member but gets a yearly salary instead or something, that's perfectly fine. Again, whatever the operating agreement says will control. In this case, the members who are not managers have no rights to manage the LLC unless otherwise provided in the operating agreement. Of course, a non-manager member is not entitled to compensation. When the LLC is being winding down or winded up, they're entitled to get their share of the ownership interest, but they're not entitled to, let's say, a salary. On the other hand, people who are managers of the LLC, unless specified otherwise in the operating agreement, are entitled to be paid compensation and whatever other normal benefits there are when you're talking about managing an LLC. But again, these things really should be specified in the agreement itself in terms of what the salary is, or it can specify that they'll pay a reasonable salary. And of course, you can hire managing members. You can negotiate with managing members, just like you can negotiate with people who run a business. You can negotiate with managing members to make a determination of their salary. An LLC is obligated to reimburse members for payments made on behalf of the LLC. Again, that's, fairly common sense. Now, who can bind the LLC? In other words, which member of the LLC can sign a contract on behalf of the LLC, and the LLC has to listen? Is it any member, or is it just a manager? Well, here are the rules, again, fairly intuitive. Any member if it's a member-managed LLC. Remember, in the member-managed LLC, everybody had voting authority. Every member had the ability to manage, or the right to vote and the right to manage the LLC. Well, in such an LLC, any one of them can go sign a contract with a third party, with a vendor, and the LLC is bound by it. When you're talking about a manager-managed LLC, where you only have some members are managing members, well, then it's only them that have the authority to actually sign a contract on behalf of the LLC, and then if they do, of course, the LLC is liable. LLC managers have the same similar fiduciary responsibilities as we discussed when we were talking about partnerships. There's the duty of loyalty. And again, the duty of loyalty, this is going to be a little bit of a review. The duty owed by a member of a member managed LLC or a manager of a manager managed LLC. Basically, if you are a manager, then you have a fiduciary responsibility to the company. You have to be honest in dealings with the LLC. Don't act adversely to the interests of the LLC. You can't usurp a corporate opportunity, usurp an opportunity, make secret profits, secretly dealing, secretly competing, representing any interest adverse to the LLC. All the same rules as we discussed before when we were talking about a partnership. And there's also a duty of care. A duty of care means that if you are handling LLC assets or LLC business, you are not allowed to engage in conduct that negligently puts the interests of the other members at risk, such as by knowingly violating the law, intentional conduct that could cause damage to the company, reckless conduct, or even negligent conduct. And so ordinary negligence or negligence that causes the LLC to suffer some sort of a debt or to be sued. Let's say, for example, I'm managing an LLC that owns a restaurant and I negligently leave the food out and somebody gets food poisoning because of that. Well, then that person can sue the LLC under the doctrine of respondeat superior that we discussed before, and the LLC can then turn around and sue me for a violation of the duty of care because I messed up with the company business. I negligently messed up with the company business and therefore caused them to be liable. There is no fiduciary duty, as we discussed before, owned by a non-manager member, because the non-manager member doesn't have any role in the managing or the running of the company anyway. So that person doesn't have any duty of loyalty. If I only own a share, if I'm only an investor, let's say, so I own a share of an LLC, but I don't manage it, and I want to open up a competing business, or I want to, do business with the LLC, that's fine. I can do both of those things, and the reason is because I don't owe a fiduciary responsibility to the company. As far as an LLC goes, again, it can expire only by dissolution, if its time runs out, or something to that effect, not by simply one member leaving. If an LLC is about to expire, members can vote to continue the LLC, or it can be continued as a quote-unquote at-will LLC. At-will LLC means perpetual, means it can be continued after its term expires if there is a vote for it. When you're talking about winding up an LLC's business at the end, well, the process of preserving and selling an LLC and distributing the property and to creditors and members is the winding up process, and the same basic rules apply here again as we discussed when we were talking about a partnership. Creditors are paid first, and then including capital contributions, and then after all of that, surplus amounts are distributed to the members in equal amounts. That is the default rule. If the operating agreement changes that, then of course whatever that says controls. And just like when we were talking about the limited partnership, to end an LLC, you do need to file articles of termination, which end the LLC's business with the same organization, same Department of State that you used when you filed the original articles of organization.